Tom Lee said on CNBC today that markets could have the right pieces for a bottom this week. As you probably know, markets came under pressure today. S&P hit a new low of this correction cycle. The Nasdaq down a lot more. And I have to be honest, I don't exactly agree with Tom Lee. Some things I agree with, but this whole notion that markets are super scared and we're too scared heading into Wednesday, that April 2nd is a big catalyst, I don't think that's true. I don't think reciprocal tariff day is a big catalyst for markets anymore. And I'll tell you why, and it may shock you in this video and actually could help you make a lot of money. But first, before we get into all of that, take a listen to this clip from Tom Lee today.
Fundstrat and Chief Investment Officer of Fundstrat Capital, as well as a CNBC contributor. At the time, I think you were talking about some of the people that work in your shop too, some of the technical people, and you were of the view that we were at least close to making a bottom. And off camera, we were talking. I said maybe in terms of timing, it was about a month early, but in terms of how far the markets actually went down, you're not off by that much. I think the S&P was down about 6%. It's now looks like it's going to be, if it opens where it is right now, it'll be in correction territory again, down 10. But you have the same kind of feeling for this week that some of the underpinnings are in for a real bottom, for a tradable bottom or a real bottom.
Yeah, I mean, both. I mean, if obviously it doesn't feel this way because over the weekend futures came under pressure, but we know markets are really oversold. We know that investors have had a lot of de-risking. And this week, I think into April 2nd, investors have three things on their minds. You know, one is they just don't know what the tariffs look like. They don't know if it's going to damage the economy. And I think third, many are just a little terrified of the policies of the White House. But post-Wednesday, I think markets are going to have some visibility, and that allows us to take some of the selling pressure off. So, yes, I think it's possible that instead of us breaking down here and seeing markets under further pressure, we're actually got the right pieces for a bottom.
Into this without knowing what's on the other side of it? That is the fundamental question that people are sitting around trying to figure out today and tomorrow.
That's right. It's an interminable wait for people because it is still 3 days, and they're fearful that we could have 3 days of down 2%. But I kind of agree with Larry Fink. I think the U.S. is going to come out of this okay. I mean, Brexit's an example. You know, Brexit happened, and the UK economy emerged okay. It didn't have a huge recession, and the stock market did okay. So for investors today, over the weekend, we had so many thinking the economy is going to completely fall off the rails after Wednesday.
Well, people are starting to say slowing growth and persistent inflation. So you put those together and you get the stagflation. Yeah, that's death for.
Yeah, I mean, there's a lot of distortions of the economy now, right? Because we know people are buying cars and wine ahead of tariffs, and that's creating inflation.
Hopefully, they're not doing it the same. You know, cars and the wine.
Do you think it's pushing up our growth numbers that we're seeing at this point, between retail sales and other places, or is that too small to distort things on that great of a level?
I think it's possible economists are only dialing in the negative consequences so far, but not the positive, because rates are down and gasoline's down, and there could be some pull forward of demand. So we might end up having better growth, so less stag, and maybe the inflation stuff is more distorting, and so it's not as stagflationary.
You've had some of your recent calls that turned out to be prescient, bullish calls had to do with inflation not being as bad as people feared. Is that still what you think? Because some of the numbers have at least given a head fake that maybe it's still around, and you throw in tariffs. We just heard what Goldman Sachs say, a 0.5 point higher on the PCE than they thought previously, and 3.5 on the PCE is not going to allow the Fed to relax.
I mean, yeah, it's interesting because Goldman did raise their inflation forecast, but then they're talking about more rate cuts.
I know, which is because of growth concerns.
Yes, and I think we'll have a glimpse of what Fed Chair Powell's thinking because he's speaking Friday after the jobs report. And I do think that it remains a more dovish Fed than many expect. I mean, I think that's what was revealed after the March FOMC meeting. And not that I'm saying it's going to put a reversal of markets here, but I think investors are a little too scared heading into winter.
Bitcoin's testing recent near-term lows, I guess, again. It's been under 80. It's not quite there yet. It definitely is a risk-off trade, and when the NASDAQ goes down, Bitcoin seems to go down. But it also really likes the idea of more Fed rate cuts or the Fed being more lenient. So if we get that on Friday, is this a decent time to be stacking?
I think so.
You do at 80.
Yeah, I think part of this was Bitcoin seasonally was just not going to be attractive until after March ends, and now we're finally exiting March, and so I think not only is the calendar looking better, but as you're saying, Fed and central banks are easing, QT's ending. I think that with positive Washington sort of tailwinds means I think Bitcoin can do well to the end of the year.
Right. People love it when I ask you what your year-end target is on Bitcoin. It makes people very excited.
Yes, and I mean,
one crazy high again.
I think it's still 150 or higher as possible. Okay. I know it doesn't feel like it, but once we get through this tariff and that agenda around tariffs, markets can look forward to things that could be positive.
Do you agree with what Larry Fink said just about the idea that the dollar could suffer as a result?
They want it to
Bitcoin.
Yes. I mean, I'd say that Washington understands that too. That's why stablecoin, really getting the right sort of legislation for stablecoin is important, because in crypto, when it comes to stablecoins, the dollar is way more dominant there than it is in traditional markets. So I think you actually kind of protect the dollar with stablecoin legislation.
Do you have a viewpoint on Sorkin coin, or you don't? I've added that to my, on my crypto board.
Yeah. How's it doing?
I think it's building.
I haven't looked in a while.
I think it's building a base.
But now I think it's.
Well, it's got a strong reputation.
Thank you, sir.
The chart looks like a coiled spring. I'm not kidding.
Wow.
Very cool.
Very cool.
Very cool. Thank you, Tom.
Thank you.
What do we decide? The crazier the hair, the higher the VIX?
Yes, that's right. As the VIX peaks, then
you just let it go nuts.
Yes.
Right? You don't even try. You just come in.
Yeah.
Blow off the appointment, haircut. Okay.
That's right. 70 VIX.
First and foremost, I know what you guys are thinking. April 2nd is not a big catalyst. What are you talking about? To a certain degree, it can be. If tariffs are larger than expected or smaller than expected, you're going to get a short-term move from that. But at this point, markets are not really reacting to tariff headlines. Trump had very positive things to say about making deals on auto tariffs on Friday. Markets sold off Friday and after hours on those comments. It's not a big catalyst anymore. The big catalyst for markets is what's happening with the economy. That's what markets care about. 20% tariff versus 25% or 15 versus 20. I don't think that really matters in the grand scope of things. It's tariffs. It's hurting the economy regardless. So on April 2nd, it's going to be more bad news. Whether it's better than feared or not can be, again, short-term positive or even short-term negative if the tariffs are bigger than feared. But it all comes back to what's happening in the economy. And we're going to have big data throughout this week that's really going to make April 2nd a nothing burger. I mean, even tomorrow we have JOLTS job openings. And then on Friday is your huge catalyst. That is the non-farm payrolls, the unemployment rate, and the speech from Fed Jerome Powell, as tomlee mentioned. That's the big catalyst this week. It's not April 2nd. So even if we do get a bounce on April 2nd, it all comes down to Friday, like last week, okay? You had a bounce on Monday and Tuesday. The NASDAQ was up 2.2% on Monday. On Tuesday, it was up 0.5%. That looked good, okay? Wednesday, rough day. Thursday, nothing, really happened. You were down 0.5%, big deal. But Friday was the big move. You were down over 2.5% on the NASDAQ. I think That's something similar we could see this week, where the real move in markets comes towards the end of the week, not April 2nd. And if you guys want me to just be totally honest with you, we're not seeing signs of a bottom in markets. We're not. I mean, look at the NASDAQ. The NASDAQ, or growth, continuing to underperform. Look at the XLP today. Down or up 1%. This is the consumer staples ETF, like recession stocks. The momentum ETF, MTUM, is down 0.6%. If we were hoping that this was actually getting close to a bottom, you would want to see growth outperform value, right? Logically speaking, that's not happening today. That's not a sign of a market bottom. I don't know why people are painting it with that brush, but that's not a sign of strength. What I will also point out is the RSI is only at 37. Again, I've talked about this for a while. This is why I wasn't calling for the end of this correction like a lot of people were in like the comment section of these videos, because you didn't get that mass panic moment, right? Just markets had got oversold. You bounced a bit. You came back down today, hit a new low, but look at that. The RSI at 37. It's not at 30. There's still room to fall. Now, you could trade sideways for a bit here. You don't have to just plummet from here. That's not what I'm saying. It's really going to go off of what the economic data looks like. And to be honest, look at the VIX. The VIX today is at 22.31. You hit a new low of this correction. VIX is only up 3% today. The high of the VIX on March 13th, when you hit the first low of this correction, was at 29.5. Even then, you didn't get a big spike in the VIX, so there really wasn't fear. Well, now there's really not fear in markets. People are not scared right now. They're not. And until you see a good dose of fear in markets, and I would argue staples sell off, value sells off, growth sells off, all in tandem, you get like a capitulation moment. We can't even talk about a market bottom until we get that. And unfortunately, it seems like that fear may revolve around the economy. If the economy gets weaker, then we may get more fear. But we're not there yet. Not even close from my references. Now, Goldman Sachs this morning gave a new 12-month S&P price target that is at 5,900. They say, quote, "We cut our S&P 500 return forecast to negative 5% over the next 3 months and positive 6% over the next 12 months from 0% and 16%. This implies index levels of 5,300 and 5,900 due to higher tariffs, slower growth, and rising inflation. We lower EPS growth forecast to 3% in 2025 from 7% and 6% in 2026 from 7%, with the new EPS estimates of $253 and $269 below both top-down and bottom-up consensus." Okay, this is something I've warned for a while now, okay? It looks like 2024 EPS is going to come in around $237 or so, okay? So Goldman's saying, hey, 2025 is going to be $253. But the average recession, excluding 08-09, because of some of the EPS distortions you've seen from the losses in the banking sector, EPS tends to decline on the S&P about 15%. So if you shave off 15% from 2024's EPS of $237, you're looking at about $201 of EPS. That's how far off markets could be right now in their expectations. Even Goldman Sachs at $253 of EPS this year is well below Wall Street's consensus. But what if we only come in at $201 or $210 or $215 or $220? You know, even something like that would be a big problem. Now, times that by 18 times multiple, which is generous if we go into a recession historically. That's 361 on the SPY. That is way lower than 530, Goldman's lower end target. That's the risk in markets. The risk is in markets that we're really underestimating, or I guess overestimating what EPS will look like this year and underestimating the potential of a much weaker earnings backdrop. I mean, even consider tariffs. Like, I don't think people are going to be willing to pay substantially higher prices for products anymore. I mean, most people feel like we're already in a recession. They'll just cut back and not buy as much. And I think that's what you're starting to see now. In that scenario, you don't have inflation, okay? Because what's worse? Like, keeping prices the same, taking the margin hit, or shutting down your factory. Shutting down your factory is much worse for your company's margins than just taking a margin hit from tariffs or not able to pass cost on to consumers. So I think this could actually be worse for company margins than for, rising inflation. I don't think inflation is going to be the problem this year, believe it or not. I think it's going to be company margins and whether or not, again, we go into a recession. You can also see today, like the VIX, something I've also pointed to, at 22.78. Although we're hitting a new low in this correction, the VIX is down a lot from its highs at 29.5. Okay, that was the high you were at the last low over here on March 13th. But now today you hit a new low and the VIX is only at 22.75. There's not a lot of fear out there. And that's what I'm going off of to kind of judge where we are in this correction. How much fear is there? Are we seeing capitulation? And we're not. So from that perspective, we're not at the low yet. And if we continue to do this, it's going to start looking like 2022. Where you kind of fall, you bounce a little bit, you fall more, you bounce a little bit, but you don't really get that level of real fear until markets are down a lot more. That's kind of the setup that we're starting to be presented. Okay. Now, CNN's Fear and Greed Index today is sitting at 19. So you are in extreme fear. Market momentum, extreme fear. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, extreme fear. Market volatility is neutral. Safe haven demand in extreme fear. And junk bond demand currently in fear. If you take a look at the percent of stocks trading above their 50-day moving average, currently sitting at 23.25. So 3% of stocks are breaking below their 50-day moving average today. It's, pretty rough, but like comparing where you were in 2022, you can get even lower than this. At one point, September of 2022, there was only 9% of stocks above their 50-day moving average. So you could, again, still get materially worse from here. And I think this is a lot less reliable than like the VIX or the RSI and actually predicting where we are in this correction stage. Something else that will be big to watch later this week is what happens coming on Thursday when we get a new AI investor sentiment survey. Okay. The last week's survey, bullish investors jumped from 21.6% to 27.4%. That's not, again, showing a lot of fear. Neutral investor, it is a lot of fear, but relative to where we were at 19, that's better. Okay. Neutral investors climbed from 20.3 to 20.4, and bearish investors fell from 58.1 to 52.2. So again, do investors get super bearish in this week's AI investor sentiment survey, or are they kind of okay with the volatility that we're seeing? Now, here on the day today, this is the last trading day of Q1. So there's a lot of portfolio rebalancing as well. And I think that's part of why momentum is selling off so much today. High beta, high growth stocks are selling off today. And some of your consumer staples are getting bought. That is in and of itself kind of prep for a recession. So you are seeing the recession trade today, but you're not seeing the fear recession trade today, if that makes any sense. Again, in the whole bunker analogy that I used over this weekend, It's like people right now, they're getting their to-go bags ready with their, batteries and food and blankets and all that. But they're not building a bunker yet. Like, we're not there yet. But they're starting to prepare for this recession. Now, Chicago PMIs today came in a little bit better than expected, but I mean, they've been negative for what? 2023? They've been negative for a very long time. So it wasn't really a huge catalyst this morning. Dallas Fed Manufacturing Index for March came in at negative 16.3 versus estimates of negative 12. So manufacturing index out of Dallas came in not great, to say the least. And you're really starting to fall lower again. And you're now at almost the lowest levels you've seen in the cycle. The lowest you were at was January of 2024, but you're definitely just nosediving straight down, which again doesn't really add to the confidence of avoiding a recession. Now, coming tomorrow is my birthday, April 1st, if you were curious. We are going to have some important data. ISM manufacturing PMIs, expecting those to dip back into negative territory. They were above 50, which is technically positive last month, but you're expecting that to fall to 49.5. JOLTS job openings for February are not expected to move much, which I think is kind of weird, right? I think you're probably going to get some weakness here. Last month was 7.74 million job openings. You're expecting 7.63 million job openings. So only a decline of about 100,000. But sometimes this can move like a lot, right? You could see a number at 7 million coming tomorrow. And that would be a sign that the labor market and really the economy is continuing to weaken, maybe more than expected, clearly, if that number comes in lower, which is my expectation, which again is not exactly great for the whole recession trade that's starting to be put on. Tomorrow, we will also get the RCM TIPP Economic Optimism Index, expecting that is actually going to get a little bit better from 49.8 last month to 50.1. And surprisingly right now, these surveys have actually been pretty important for the markets. I mean, expectations tend to kind of precede reality. So if people feel bad, the data tends to get bad, if that makes sense. And that's why soft data can be important. Now, the soft data right now is crap, and it's really about the hard data this week. Again, JOLTS job openings is hard data. On Wednesday, you don't have anything for hard data. On Thursday, you have services PMIs, not exactly hard data, but something the markets pay attention to. On Friday is your big data, non-farm payrolls and the unemployment rate, and a speech from Fed Jerome Powell to kind of wrap up this week. And I think that can actually be a huge catalyst as well. So it's kind of like last week where, we had some data throughout the week, but the big data was on Friday. And that's the only thing that really mattered. That's kind of where we are as well this week. We're going to have some data. We're going to have some events on Wednesday, reciprocal tariffs. But does it really matter? Not really. It's about that jobs report and unemployment rate on Friday. Bank of America says trend followers are building U.S. equity shorts ahead of the tariff deadline. CTA models show growing short positions in the S&P 500, the largest since February 2016, and NASDAQ 100, the most elevated since January of 2023. Short and long-term traders likely hold significant Russell 2000 shorts, while European stocks remain long and Nikkei 225 shorts. A Euro Stock X50 sell trigger is just 1.2% away. And the UK Prime Minister's spokesman says that he expects the UK will be impacted by US tariffs this week. And according to a CNBC survey, first quarter GDP growth will be just 0.3% as tariffs stoke stagflation conditions. Now, what's interesting is the Atlanta Fed GDP Now tracker, adjusting for gold imports, is actually negative 0.5%. You could see a negative Q1 GDP report. So we could already be like in a recession. Because what happens if you guys have never like lived through a recession is, you know, Q1's negative, let's say Q2's negative, but by the time you are declared in a recession, it's like June, July, right? Once you get those final Q2 negative GDP numbers, by that point, markets are already down a lot, right? Because everyone already expects that you're in a recession. And then subsequently following that over the next couple of months is usually when markets start to actually recover. So you're kind of in that pain window here, leaving Q1 into Q2, especially if the data that we get over this, this week shows that GDP could actually be negative. Again, from that standpoint, is April 2nd a big catalyst? Not really. I mean, is it going to change much? Not really. Again, from a positive or negative perspective, it's probably going to be right in line with expectations for tariffs. Like, 20% tariff across the bat or 15% tariff across the bat. Still going to weaken the economy. Not going to save us from not going into a theoretical recession. Goldman Sachs today also raised their 12-month recession probability from 20% to 35%, with recession odds that are currently at 43% and rising on Kalshi, which is, again, kind of just showing you where we're at in markets. Still only a 43% probability of recession deemed on betting markets. Like, imagine what happens when this thing gets to 70 or 80, where the markets are going to be in. I think inevitably we probably will get there. And again, unfortunately, I don't mean to sound super bearish, but it's hard to be bullish because tariffs are going to hurt margins. Earnings are going to come in weaker than expected this year. Recession or not, that's not a good backdrop for equities, right? And people have high expectations. The positives to Trump's administration's, growth efforts like tax cuts and deregulation are going to take some time, right? Even Trump himself and Scott Bessent have said, essentially, be ready for a recession because that could happen, quote unquote, detox. Like, that's not something I want to get ahead of, trying to call no recession, as a lot of people have. And the fact of the matter is, markets are not cheap. Just normally speaking, like average, but or average over time. But consider if we do go into a recession, the markets are grossly overpriced for that economic scenario. And I just think the cost of capital right now, or the equity risk premium, if you will, doesn't make a whole lot of sense to the upside versus the downside. I think there's a lot more downside risk than there is upside risk. It's like if you had a 1 in 10 chance of 5xing your money or something, but if you're wrong, you're gonna lose it all. Like, does that make sense? Hopefully that kind of makes sense. Like, would you do that if somebody said you had a 1 in 10 chance in 5xing your money or getting insanely rich, but if that 9 out of 10 odds goes against you, you start at nothing, essentially homeless? Would you do that? Probably not. I know that's dramatic, but that's kind of where we are now. It's like, what, we have 10% upside from here, but maybe 40% downside or 35% downside with some of my calculations. That difference doesn't make a whole lot of sense. As I've talked about before on this channel, once you get down to 500 on the SPY, I think the risk is in parity. I think there's roughly $100 of upside on the SPY back to 600, and I think in the worst, in the more dramatic, bad case scenario, there's about $100 of downside as well. Now there could be more than that, but I think logically speaking, 400 on the SPY would be close to a low, even if we did go into a recession. So I think that's where the risk is at parity. That's where I would feel more comfortable taking out or putting in larger bets on this market. But here, there's no incentive to do that. Actually, there's opposite. I mean, the lower markets go, the more valuable your cash becomes because you can buy more with it. So as markets fall, if you're in cash, you're essentially getting paid to sit in cash. If you think about the next couple of years. And that is why I like cash right now, because, I mean, what are the odds that Trump backs down from all tariffs? Like nothing. That would make him look like a fool, right? What are the odds that they come to a deal anytime soon before it has the opportunity to push us into a recession? We may already be in a recession. The damage may already be done. So whether a deal comes or not, it probably will be too late. Okay, to at least help, earnings for the next, couple of quarters, things like that. So, there's just not a lot of upside risk here in markets. And that's the fact of the matter. But again, as I've said on this channel, it's not about being all in or all out. I think you want to be prepared for a recession. I think that means having as much cash as possible, doing side jobs in your real life to earn as much money as possible. $100, $500 today in a recession could turn into thousands invested in the right stocks at the right time, right? That's what I mean, that you're getting paid for sitting in cash, because your cash is going to be worth a lot more buying depressed assets during a recession. Okay, so that's what I'm doing. I haven't really sold any of my long-term stocks that I have high conviction in. Anything that could go bust in a recession is long gone by now. And I don't think it's too late to do that, right? To de-risk portfolios. In that sense, raise as much cash as possible. So cash is king right now, and that's the best way to play it, because there is a chance, there's always a chance markets just go right back up again. Trump backs down from tariffs, makes himself look like a fool. That's fine. Maybe that happens. I think the odds of it are low, but you want to be prepared for it if it happens. You don't want to be all out of this market and miss that if that does ultimately happen. But you don't want to be all in margin and all prepared for the upside when there's a lot less of a chance we get that large upside versus additional downside. So ladies and gentlemen, let me know what you think about all of this information down below in the comment section. I know if you don't agree with me, feel free to let me know down below in the comment section. I stick my neck out on a line to hopefully help as many people as possible to at least put this market into a little bit of perspective and highlight probabilities. Nothing is ever a guarantee in markets. The best you have is probabilities. And I think the probabilities well outfavor the upside here. In other words, I think there's a lot greater chance that markets come under further downside pressure than V-shaped recovery back to new highs, because that would essentially mean that Trump would have to back down from his tariff policies. And I don't think he wants to look like a fool. In fact, I think that's the last thing he wants. And that's exactly what would happen after promising on the campaign trail that, he's going to make countries pay their quote unquote, fair share. I'm not willing to make a bet like that. So let me know what you think again down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.